Record the following transactions on the books of Wristflex Corporation. Omit cost of goods sold entries. So for part A, we got on June 1st, Wristflex Corporation sold merchandise on account to Don Play Incorporated for $22,040. Terms 3 out of 10 and out of 30. So you got debit accounts receivable for $22,040 because it's sold on account, and you credit your sales revenue because that's just how it works. Now, Part B says, on July 8th, Don Play Incorporated returned merchandise worth $2,240 to Wristflex Incorporated. So you're recording the POV of the seller. So you debit sales returns and allowances. That's only an account, a contra asset account the seller used. And you're going to credit accounts receivable because it goes down because you got to give them back their money since they returned your shitty merchandise. Now, Part C says that on July 11th, Don Play Incorporated paid for the merchandise. So first thing you gotta do is credit accounts receivable for $19,800. That's because you taking the amount you originally sold your merchandise for, $22,040, and you subtract that by the amount that Don Play Inc. then returned the merchandise for. Alright, now then you debit sales discounts for $594. That's because you multiplying the new amount after subtracting the returns by the 3% discount. Now finally, then you debit cash $19,206. That's because you subtracting your sales discount from what you had for the accounts receivable. And now you're done.